a fund manager who never lost a single dollar of clients' money despite trading through COVID crashes, tariff volatility, and managing other people's wealth in his early 20s.
I think right now, market volatility, the geopolitical situation, everything that's going on in the world, there is a lot of lower time frame opportunities. A lot of the big moves that we have, a lot of the reversals that are happening is because the market doesn't even know where it wants to be positioned. And in those times of uncertainty, holding a position for a longer time frame, for a month, 3 months, you need to be very certain that that play will work out.
Introducing Anav, a Dubai-based hedge fund manager responsible for trading multiple 7 figures of other people's capital. In this episode, Anav reveals exactly how he builds a portfolio to guarantee 10 to 15% returns before risking a single dollar in discretionary trades. Exactly why he stays awake during Asian pre-market open to exit every trade manually, and his exact hybrid strategy that allows him to capture massive upside while keeping his drawdowns minimal.
The client's reading a lot of stuff about what's going on with oil, the war breaking out, so they called me and said, hey, I don't know what to do with my funds. But there are so many things that you can do. Ultimately, you still want to understand you want to be right more times than you're wrong, right? Yes, you can have a lower win to loss ratio and still make good money, but ultimately collect those wins for those times where you feel psychologically that you are not being able to find those winning trades. Even if that trade makes you $1, what it does for you psychologically is going to help way more.
What is the number one reason you're not making money? Usually people jump to say, it's my psychology. Then you go dig deeper and say, what is it in your trading psychology? I think the number one word would be fear. Whether that's fear to enter the market, fear of missing out, fear of unfavorable outcomes, and all the derivatives. I want to explore this with you because you're saying it's not something you feel so much. Do you think these things are amplified within the market in your early days or outside of the market?
That's a great question. I think one is definitely.
So Titans, before we jump into this episode, a pretty unique one because it's not very often you speak to a hedge fund manager, let alone a multi-7-figure hedge fund manager in his early 20s, and most surprisingly, the setup and infrastructure he uses that results in guaranteed returns for his clients before he even places his manual discretionary trades. So what we have done with Anav is we've prepared an episode companion. This is going to be a full PDF breaking down his exact mindset, his beliefs, his framework and systems that he uses, and exactly how he sets up guaranteed returns plus his discretionary trading strategy. So with that being said, click the link in the description to grab your PDF for today's episode. It's completely for free and is designed to make sure you get more value from each episode. And without further ado, let's kick off today's episode. Ladies and gents, welcome back to another episode. I'm joined by Anav. Bro, thank you very much for joining me today. It's very interesting because usually the people on the show, they have a large social media presence and people are very familiar with them. You're kind of a submarine where you're not really known online. You're not in the education course space. You're in wealth management and out of Dubai, local grown talent. I want to get into the AUM. I want to get into managing clients, families, as you call them, the trades you take. What is your process to getting investors, placing trades, keeping investors? There's a lot to unpack here. But I want to start off with, first of all, give me a quick rundown on the journey. How did you go from working in an institution to, in essence, being your own?
So my journey also was made redundant by COVID, right? When I started off, I was very young in the space. I was still coming out of graduation. I was just starting to work and getting that experience in. And then after that COVID happened, most of us became redundant, looked elsewhere for work, right? At that point of time, I felt like I wanted to explore different avenues of my life, right? Did they pan out the way I wanted? No. Ultimately, the markets kind of told me, go back to what you're good at doing. And that's when I pivoted back, right? So it became institution to trying other business ventures to coming back into investing.
Okay.
Yeah.
And with that pivot, obviously you're like, okay, I've had this exposure, I've got a baseline knowledge, but then pivoting to being all the weight is on your shoulders, and now you're responsible for a team and also families. Mm-hmm. What was the journey to go from idea to execution?
Right. So for me, it wasn't like I was out of the market, right? I was not trading or investing for other people per se. I was still doing that for myself and for a couple of friends and family members, right? So my involvement in the market wasn't on and off. It was mostly taking a break from managing from others, taking away the stress from doing that, focusing on myself, building my strategy out once again, while still investing in trading, and then coming back to expanding that into a more formalized setup where I can take in funds, where I can work with individuals who have certain requirements or challenges or needs that need to be fulfilled as well.
So now that you do have several families and a nice pot of assets under management, walk me through the process, because you have a unique twist you mentioned off camera of guaranteed notes. So this screams to me huge liability, that you give some sort of guarantee to your investors or clients. Talk to me about that.
Great. So it's not me who's giving a guarantee. These are notes, almost like promissory notes or a bond, right, that will yield a certain amount. So based on the client's risk tolerance, they can choose to have X amount that they make, and there's a downside of X amount, right? When it comes to a guaranteed note, usually the yields and the returns will be limited, so anywhere from 10 to 15%, but that is guaranteed year after year. Right, how that is underwritten is because these are notes that are coming from issuers like JP Morgan, issuers like Standard Chartered. These are big institutions that are taking the liability. Now, will a JP Morgan go out of business in the next 5 years? Probably not. Same for Standard Chartered, same for all the big issuers of these, what we call private bonds, structured products, guaranteed notes.
So with these guaranteed notes, because I'm actually not familiar, let's say you put something as simple as the S&P 500, there is a almost guarantee that it typically performs at 7 to 10% a year historically, but there's always bad years too. So is there something to this effect where it's an assumed guarantee, or it's a high probability, but there is also a chance that you could have a bit of a bad year or flash crash and so forth? Or is it truly a 10 to 15% guarantee?
It's truly a 10 to 15% guarantee. However, if you want to capitalize on potential upsides that you feel like there might be, you can also have that structured into your custom note that is still underwritten by a larger institution.
So can we refer to this as just like a bond paying interest
Almost
yield?
exactly
Okay.
that, yeah.
Okay.
And the lock-in periods aren't as long, can be anywhere from 1 year, 2 years, depending on what you want, depending on who's issuing it. Custom ones can be made. But what we see in today's investment trading landscape is, like I said, a lot of clients are unaware of who to invest with, what they're investing in. So they tend to prefer a product where they have safety while also getting to make sure that their funds are actually deployed in the market rather than them sitting out, right? No one wants to be on the bench watching everyone else make good money, right? So this is a way to protect themselves against inflation, against any downsides, but also lock in a certain amount of money coming in every year.
This is actually beautiful, because if I'm to think what I could invest in as an individual, I would think, okay, let me go for the S&P or a halal equivalent, let's say, which is what I'm doing. Okay, I get my 7% a year. If I do property in the UK, probably 5-6% appreciation, but then I'm realizing, well, inflation is 4-5%, so my actual asset appreciation buying power is just a couple of percent. With this 10 to 15, you have a healthy breathing room. Is this something a individual can access, or is this only on a institutional level?
Not many individuals have access to really good products. That's why even I have some partners to get access to certain products. Even we work directly with certain issuers to get these products directly. So
and
a
how
lot
does
of
it work? It's who you know, or it's upon a threshold of investment?
either or, right?
Okay.
So sometimes you can have a great network and you'll have access to the products, or you speak to a wealth management firm. Most of these companies will have access to the products because they will filter out the people that are serious. They will take in the funds and make sure everything is done with due diligence, compliance, so on and so forth, right? But individuals going online and just purchasing something like this, usually because it is not very low ticket, they usually wouldn't have access. The volumes aren't there for them.
And you're using these vehicles as a hedge in your portfolio. So
Absolutely.
you'll have your active component, which is you're trying to beat the market, and then this is your safety net. So how do you divide the pots? Let's say there's $1 million to play with. How do you distribute that between, let's say, actual bonds, high interest accounts, these investment products, maybe just the S&P? How do you divide this pot when someone deposits?
So for a client, typically we do like a risk assessment. We see and discuss with them how they want to be positioned in the market. And how they don't want to be, right, ultimately. So if for them, someone that is extremely conservative will say, hey, I'm going to lock that $1 million in, and with the 10% that I make on that, I will put that 10% into you trading discretionary, for example, right? So then they have a good split there. Or they will say, let's put 50% as protected fully, and then 50% you trade with as a discretionary trader. So you can have both setups. It just depends on what the person wants at the end of the day, right?
And you yourself are involved hands-on placing the trades as this discretionary portion of the portfolio?
Absolutely. So I do also spend time on the markets. I do always look for opportunities. My strategy today, especially with the market conditions, is to find real winners long term, right? There are some short term opportunities, but for me, is finding and picking winners long term now. Enterprise AI is somewhere that I've looked at that I see very good potential in. So in companies that look really promising, when I invest or take a trade in those companies, I would also then look for shorter, lower time frame opportunities to then take it as a day trade or intraday trade, or as an add-on to my position, right? So it's not just trading one thing 10 times over, but it's having 10 different active trades and seeing if we can keep following the trend along with those trades.
Let's take a moment to talk about a partner of the show, a leading prop firm that is FundedNext. And it's important for me to listen to our community to see who are you working with and how can we make your experience better. And the main feedback I heard is trusted payouts, quick payouts, ability to scale, and affordable prices. And FundedNext has ticked all of those boxes, not only being a top 3 prop firm in the industry, but also having on-demand payouts, and every 10% you gain on your account, you will double your capital for free. And because in this industry, trust and reliability is the most important factor, an important guarantee that they have is that if you do not receive your payout within 24 hours, they will gift you an additional $1,000 to your payouts just for being late. So to unlock all of these benefits and work with a leading prop firm in the industry, FundedNext, check out the link in the description or use the code TOT. So I definitely want to dig into your beliefs, your strategy, your approaches. But before I do, I want to explore individual trading that you're doing in the past, just your money, your accounts, and maybe a few friends, to now managing larger capital and other people's money. Walk me through any differences, whether it's, let's say, actual limitations, ability to go on the lower time frame, risk relationships, or even just psychology. What are those opposite ends of the spectrum?
So when you are managing other people's funds, that pressure does start to kick in, right? You want to be extra sure. As a trader, you want to be very disciplined. You want to not think about this, that, and the other, right? It does become increasingly difficult. Thankfully, today, as we speak, I have not lost any clients' funds so far. Brilliant. But even still managing those funds does come with pressure, right? Still, sometimes when you're flat and you have no wins, no losses, you're just kind of out of the market waiting for the right opportunity, clients are still wondering why you're not making money with their funds, right? So it does become a bit of a balancing act, but I feel like I am thankful that all the clients that have invested in me so far are very happy. They check on me more than I check on them. And they're always telling me, whatever you're doing, just keep doing it. We don't need so many regular updates. And these are the best clients to have. But then there are also some clients and certain people who want to know every week what's going on, right? And I tell them every 2 weeks, every month, we'll give you updates. But they still reach out to my assistant, to other people, and say, hey, can you just give us an update? So now we have kind of like tracking dashboards for them, just so that they are more in the loop. And we work with these people because not everyone is very comfortable investing, right? A lot of new investors, a lot of people seeing all of these growth stocks in the market, seeing so many opportunities. Gold was going up and up and up, right? So people now want to jump in, they don't know where to go. So I help them bridge that gap as well, especially when funds are at a certain size. They won't be happy making $10,000, $20,000 extra a year, right? They really want to lock in their returns and fund their own lifestyle and make this a passive income for them. So that is the approach.
Do you find it, just curiosity here, being very close with your clients and becoming almost their friend helps you, or kind of distancing yourself so you kind of, if it's a bad moment, you don't have that attachment, like, oh, that's my really good friend and it's not going well. What is that portfolio to client relationship like?
I generally always love a good client relationship. For me,
keep it active.
Yeah, I feel like if they're my friends, there's always going to be a good time together, right? Sometimes I don't want to take in a client if I don't like them or if I don't agree with their values, right? For me, it's if I generally enjoy spending time with that person, or they're just a good person that I feel like has a lot of potential to kind of improve things in the future, then yes, I'll work with them for sure. But for me, I love an interpersonal relationship with them. A lot of the clients that I have, also their children are also kind of asking me questions about the markets and what's going on. So I do like to make sure that I'm seeing where the wealth is going to generationally, And I feel the responsibility to protect it just as much as the parents do or as the families do. They've also worked very hard for their money. So someone should also look after that with the same kind of ferocity.
Do you feel the same psychology you felt when you were trading your own money, when you're trading other people's money? Because you can either detach and say, well, it's not my money, and or you can say, oh, this is other people's money, generational effect, and therefore it actually amplifies any psychology that you had in the past.
So when it's my money, I don't mind losing it, right? Because I know I can make it back again. I know that there's a lot I can do to make that back, right? I have the freedom of time. When it is a client's money, if I'm down for this month, I know that next month I'll be fine. If I'm down for 2 months, then I'll start feeling the pressure, right? I have not been down more than a quarter. And so far, so good, right? When that time does come, hopefully it doesn't, I will understand a little bit more about how to manage that. But I don't feel fear. And just as a person, I don't enter the market with fear.
Why do you think that is?
I feel like for me, I never had to face such harsh consequences in terms of losses because my risk was always protected, right? My downside had to be protected. I didn't have the freedom of taking larger bets because of the institutional background. You have very tight risk controls, right? So coming from that just made me know that my worst month, my worst quarter, I can only be down a certain percent based on my risk rules.
So when I think of that average trader and you would ask them, hey, what is the number one reason you're not making money? Usually people jump to say, it's my psychology, without even thinking, do you have an edge? But they attribute it to their psychology. And then you go dig deeper and you say, what is it in your trading psychology? I think the number one word would be fear, whether that's fear to enter the market, fear of missing out, fear of unfavorable outcomes in the end, and all the derivatives. But it's a very loud voice. Most traders will say fear is the biggest one. I mean, I want to explore this with you because you're saying it's not something you feel so much. Would you say usually people have a early life trauma or a early in your trading career trauma where you blew an account and this became now a trigger response when there is not a threat, but you feel like there's a threat based on the previous circumstance? Or is it outside of the market where it's like family, stability financially? I'm worried about rent and so forth. Do you think these things are amplified within the market in your early days or outside of the market?
I think a bit of both. That's a great question. I think one is definitely taking on losses. Going through a losing streak is very difficult to get out of, right? Sometimes you just have to take a break, separate yourself, do your homework, back test, come back to the market, right? And then explore. Sometimes when you do have a really good trade idea, but you don't want to add on to your position, for example, or you might feel like it might run the other way, so let's just play this one out. I feel like what you should be doing is, even if you're not actually taking that trade with the full risk, full position, take it at a very small risk, very small position, just because ultimately you want to be right more times than you're wrong, right? Yes, you can have a lower win to loss ratio and still make good money, but ultimately collect those wins for those times where you feel psychologically that you are not being able to find those winning trades. So just even if that trade makes you $1, what it does for you psychologically is going to help way more.
I want to explore the idea of what you may be doing that maybe you're not realizing it, but these small things are contributing to your ability to not feel fear. Because if you just say, I know my downside, I use risk management, I have my cutoffs. I think every trader has that. Whether they adhere to it or not is another thing, but everyone has that. Okay, I'm going to do 1% risk. And then even with that 1% risk on a good setup, they might not take the trade. So what is it that you're doing? Maybe it's like in a losing period, you do X, Y, Z. Maybe with a low confidence trade, you do something else. You take time off. Is there particular activities or behaviors you have to shield your psychology?
I would 100% say time off is a good one if you feel like you need it. My version of time off would be taking like demo trades, $1 trades, right? Just to keep it in the system, just to make sure I have that information that I'm tracking. So for me, it would just be taking very tiny trades or demo trades even, just to make sure I'm not out of the market, but I am kind of stepping back. I would do a lot less to
When do you decide to do that?
When I'm usually taking losses, if I have a bad month, then I will kind of start the month by going a little bit slow if I feel like I need it, and then pick up the pace. For me, also keeping profits buffered is very, very nice for me. If you are a trader, if nowadays prop firms make you liquidate all your profits monthly, if you can, or find certain prop firms that let you hold those funds and give you that buffer, use them, keep that buffer for yourself, square up money and keep it away. Just always try to look for a fail safe. If you don't have one, build that one up, and then go from there, because that will ease the kind of stress and tension and make you focus on the process rather than the profits.
So I'm going to share something that happened to me lately. I don't want to hear your thoughts. So I've been trading for just over 9 years now, and I think I've had a good career, but I was pretty late to invest in general. And I wish I'd started in my early 20s, but regretfully I left it a bit too late. But I started investing in things maybe 2 years ago, properties and other assets. But for the first time, when I saw the tariff situation, the market had retraced or crashed pretty significantly, I liquidated some things and I put a sizable 7-figure portion into the stock market. And it was a V-shaped recovery. So this was, I guess, a lot of luck, beginner's luck, or whatever you want to call it. But the reason I mentioned this is because I had such a lucrative short-term gain without having to do anything, which brought me so much mental peace, because I haven't liquidated it, so it's unrealized P&L, but it's such a, not a weightlifter because I didn't have a pressure, but it's just a reassurance, so that when I came to my day trading and I came to my normal positions, typically I'm taking 5 to 10 trades a month is my usual. Last month I took 2 trades, and okay, they were both winners, but that's not my win rates. But it just shows that I was ability to be more passive in the markets and just focus on the most quality setups. I was able to risk a little bit more because I had high conviction and I had the buffer of the stock market gains, and therefore this really helped my psychology. I was less attached to the market. I was less attached to the outcome, and even if I tell myself I'm only going to take A+ setups, I'd find myself taking other kinds of setups. And only now, when I had an investment bringing me money, a large amount of money, was I able to say, you know what, I'm not going to take that setup. I'll only wait for my A+ setup. And I'm wondering, your equivalent is these notes that are giving you a guarantee yield, gives you that same safety net of like, okay, I don't need to enter the market all the time because there's gains here if I don't take action, and worst case scenario, I'm protected here. Would you attribute any parallels from this?
I do when it comes to a client-to-client basis. For me, I don't do any kind of passive income approaches like these guarantee notes, because I would rather be on top of my own funds.
I see.
Like before, a client that does want that safety net, that does want the peace of mind. There's even one instance where we're making good money for the client, about 2 to 3% in a month for, it was like 4 months. But ultimately, the client's reading a lot of stuff about tariffs, what's going on with oil, and with the war breaking out. So they called me and said, hey, I don't know what to do with my funds. I don't want anyone investing my funds, right? So that's when we also suggested, hey, book a kind of your profits in this manner for the year, put and reinvest your money into a guaranteed note. So that way, as a client, they have peace of mind. For me, I would still prefer to invest it more actively, but you could do that as well. You could park your money in so many different fixed deposits at the bank, right? They will give you a small percentage, but there are so many things that you can do as well. However, ultimately, you still want to understand what your capital requirements are. Whether you need money to invest and trade, then you keep it there, right? But if you have extra to invest, try to diversify as much as you can, especially because we don't even know what's going on in the markets in this current moment, right?
When as an individual trader, it's pretty common and normal, whether it's prop firms or your own capital, it's kind of like 1% risk per trade. Is that something that also applies with other people's money and larger capital?
Depending on the strategy, when we trade options for a client, because you are using a more income-based approach or an income strategy, you want to be investing a lot more of the client's funds. So even 50% is exposed to the market because you're collecting premiums there. And in that manner, you're kind of making, I would say, the same approximate returns annually. It's just the funds deployed in the market are larger. but that also means your upside is larger.
Would you say that's margin used or capital allocation, or would you actually say that's 50% of the account exposed to risk?
I would say it's 50% of the cash in the account exposed to risk, with the additional being the margin, obviously, which is why it's a larger chunk.
So is that something difficult to just mentally accept, but also explain to clients, like, you've given me X amount, 50% could be up for a loss? Is there any thoughts of that coming up?
Usually, because it's not up for a loss technically, unless the stock goes to zero, which usually wouldn't happen. Usually we do have those conversations, and then we do tailor their investment approach based on that for them. So we can have these conversations. We had these conversations, and they said, why, right? So we had to explain these things to them as well. And ultimately, some really didn't like it. Some liked it. They were like, okay, we understand. Let's try it. Some were like, no, not a chance. There's no way I could potentially lose 50% in the markets, right? Even though they don't really have the risk of losing 50% unless there's a huge crash. But sometimes it does get daunting for people to hear that and think, okay, this is a strategy. Why would you do that, right?
So a couple of years ago, I was living in 5 years ago, I was living in Spain, and I met a guy through a friend, and he was a young guy, mid-20s, and he just had a very wealthy family. So the family had a very nice boat, and he would go every year to Ibiza, and in Ibiza he would network, party with rich people, and just basically sell his services of wealth management. And he would have a performance percentage and also a management fee. And he would laughingly say, I just put it all into S&P. I'm like, I'm not actually trading. I'm not actually doing anything. I just take the money, put it into these simple things. I know I'm going to get 10% a year, whatever, but I'm also getting my management fee. I'm also getting a percentage of performance, and the clients are happy too. So he was kind of, let's say, rigging the system, and it will have its bottlenecks and whatever. But the reason I mention this is because the easy approach exists as a wealth manager, whether it's like, I'm going to put it into just surefire things. You could also put your entire portfolio into these notes and just say, I'm going to sit back now, relax, and get 10 to 15% a year. Why do you choose to remain active in discretion trading? Because not only is it mentally taxing, there's also a potentially real downside, as opposed to just accepting 10 to 15% is more than enough to get clients money.
For me, it might be enough to get clients money, but I don't feel like it's a win on the year unless I've outperformed S&P, right? For me, and I guess a lot of people, right, they look at S&P. If you can outperform S&P, you've actually done well, right? As a fund manager, as a trader, as whatever. But because there's an easy approach, which is like your network or your friend said, just put it in here, close your eyes, enjoy your time. You could do that approach, right? But I feel like once you have your edge, once you've refined it, and once it works well, it becomes almost like that hunger and that drive to keep improving it, to make more gains. And to outperform the S&P always feels great, right? Especially when S&P is down one day, which was like 2-3 weeks ago, where it was down and up and down and up. We also are tracking that to see, hey, are we doing better than it or not, right? So at the end of the year, wherever S&P is, whatever their returns are, I know that I have to outperform no matter what. That is a challenge for me, and for everyone to kind of use S&P as a tracker as well.
What are the main markets you are trading?
I would say commodities is when I'm trading, in U.S. equities as well. I really like U.S. equity plays. A lot of tech plays out of the U.S. have huge upside potentials, and their volatility is something that you can, once you capitalize on that, you get really, really good returns, especially on some trades where you can take it as an options trade, and you get a huge jump in price when market opens. That is where you also get your 1 to 5s and above, right? With swing trading, with day trading, I would say you can get the 1 to 5s and above. With swing trading, 1 to 2, 1 to 3 is generally great. But with options, you also get the 1 to 5s and plus, just like day trading, but with more safety, I would say, if you know what you're doing.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them and the thousands and thousands of viewers, you guys, that have been working with them through the discount codes of Titans of Tomorrow, it's clear for me to see why they are a top-ranked prop firm in the industry. They have also reached a monumental milestone of $100 million in payouts. And with the multiple step plans and the multiple package types they have, there's going to be an option catered specifically for what you're looking for. So you can buy an evaluation account catered to your needs at the most competitive prices, and with our discount code TOT for Titans of Tomorrow, you're able to get the most unbeatable, unmatched prices in the industry with a leading trusted prop firm. And with that being said, let's get back to the episode. And between you and your colleagues, how do you divide trade idea generation, conflicting views you may have between internally and risk? How do you trade as a team? Because previously, individual trader, individual decision, individual responsibility. Now it's other people's money and group mentality. How does that go?
So this was something that I've been actually kind of struggling with. I would say in the last 2 months, we brought on a day trader to the team. Great track record, FTMO's leaderboard couple times over, done really well, right? But his strategy is ultimately different from mine, right? He trades a lot more aggressive, in my mind aggressive, because he's more active in the market generally, right? Which I am a lot less in terms of the frequency of my trades. So for me, watching him trade or just seeing his orders on the system and seeing how he's performing, a lot of the times I wanted to close off some positions, right? I feel like we juiced out and, this is for the day, very good, book your profits, move on, right? But ultimately, I have to not do anything. I have to just support. I have to make sure this is your strategy. You're coming in as a professional, you manage it yourself, right? I'm not there to just kind of point fingers or poke, because sometimes if I say, hey, exit here, and price keeps going, then they will say, hey, we kind of missed out there. But if I exited there, booked profits, and it reversed, then they'll be like, oh, you saved me. But that is not something that I should be doing, because I have to focus on my strategy. And another professional will come in with their strategy, and like they have, and they've done well with it, right? So it has been a bit of a struggle, I would say, in the last 2 months, just not participating when someone else is participating with the same funds. But ultimately, you just have to have a hands-off approach. We still discuss things generally, but I'm not coaching anyone in that regard, right? Everyone is coming in with experience. Everyone's coming with their own strategy, with a proven track record. Things work, and they work for you because you've developed it. Now you go ahead and do that, right?
Well, thank you for sharing the struggle, but it's also an interesting topic that we can branch off, because you as the leader of the team, you have your team members, and I guess they all are responsible for portions of the pot, and you might be like, okay, you can have the discretion to do your entries, and then when you could give advice on the exit, you could either have the I told you so moment, or oh sorry, my bad, you should have held it. That clash that can brew animosity over time, which from your side, leadership, it makes a lot of sense to give them the autonomy that they have based on their track record. But it's also interesting because someone may see, oh, well, if you're in profits and the leader that is thinking of the whole portfolio, he should be the one deciding risk and deciding these kind of things. But maybe this individual's edge is not in the entries. Maybe his edge is in his money management, in his exit, in his foresight to say and we don't know, one small decision might trip into the decay of the edge overall, which we might not see from a bird's eye, but it could be a domino that sets off a chain of an edge going away because of oversight from you. And managing clients in traders in such a way. How do you allocate to the pot? Is it just equal between all traders, or is it a hybrid risk approach? Because then you could say multiple traders are exposed to the same position right now. Do I want asset class exposure limitation? How do you manage risk at a larger level?
So I would say making sure the funds are fully deployed is one thing, right? We don't want to be sitting on any capital that is unused, because if anyone's giving us capital, we want that money to work for them, right? So we have to put it to work. So whenever there are opportunities, whenever there are really good opportunities, we will discuss them internally. When it comes to day trading, I've allocated a certain amount of funds for them to day trade with full discretion, right? They can do whatever they want, but when they want to size up and take a very large position, then is something that we discuss. But generally speaking, I try to stay hands off when it comes to that. Those who do well would get allocated more funds, simply put, right? It's a thing that takes time. Me bringing on day traders was primarily because there is a lot of lower time frame opportunities, right? A lot of the big moves that we have, a lot of the reversals that are happening is because market doesn't even know where it wants to be positioned, right? We can have our approach, we can have our bias, we can even have our entries, but I can conflict with you, I can conflict with another trader. Doesn't mean either of us are right or wrong, right? So for me, it's just making sure they're comfortable at the end of the month, making sure we go through the analysis of their trades, seeing where there's room for improvement, why, and kind of pushing them to be better and better. And making sure that they're also rewarded for that by seeing a forward momentum, upward trajectory when it comes to the funds that they manage with me as well.
What is your thoughts? Because I spoke about this yesterday, which is why it's in my mind. Someone that is swing trading is obviously going with either a technical edge or a fundamentals edge, but typically they're going to be going with the tide. So they say the trend is your friend. So a very default position of most swing traders is just follow the trend. If it's a bullish market, look for retracements and long opportunities. Because I'm an intraday trader, I actually had the stance of there can be very high probability portions of the market. I'm not trying to capture the entire move. I'm trying to capture a very high probable portion of the move and then cut it as well. Meaning to say there is also high probability counter trend positions where in a bullish market I might sell the retracement, catch only a piece of it, not even the entire retracement, and that might be more high conviction, more high confluenced, maybe even higher win rates than the with the trend play. Which is maybe what some of your intraday traders are doing. From a bird's eye view, yourself being a swing trader and probably with the trend and maybe seeing somebody countering your position. If you're long on something and you see a day trader is selling that, how do you balance that in your own mind of intraday narratives versus swing narratives?
Yeah, so when it is a very good long position, for example, for a swing, when we're entered, price might be moving the direction, we might not be ready to exit that position. But we do know there is going to be a retracement naturally. So on those times of retracement, the day traders want to take a short position and maybe even retrace it all the way back to entry. Full freedom for them to do that. Even sometimes I would do that as well, right? I would, because I'm already in the long, when we do reach a good price target, and I know and I can see the trade and price start reversing, I would also take a same short position on the long, right? That way, not only am I hedged, if it continues to go the other way, it goes the other way. But if I'm coming back to my original entry, then I get the benefit of having a nice little tidy profit booked away. If my stop loss is at break even, great. Even if it hits, I've made money from that trade, regardless of what happens. So the more active that you can be in terms of managing your own trades, looking for the same entries on a trade that is working out in your favor, good for you. You know, those are opportunities that you don't want to miss. And in these market conditions where being a swing trader, I wouldn't say is the best. I would say intraday, day trading has a lot more opportunities right now. That is where you can find very, very good opportunities.
What makes you say that right now is better for intraday and other times would be better for swing? What causes better conditions for certain types of trading?
I think right now, market volatility, the geopolitical situation, everything that's going on in the world, a lot of fund managers, a lot of larger institutions, even looking at the volume profiles of large assets, indices, you see that the momentum has started to dry up a little bit, right? So just seeing that the commercials are not really there in the market to take very big positions or relatively big positions from our side or regular positions from their side tells us as an indication that even there is a bit of uncertainty. And in those times of uncertainty, holding a position for a longer time frame, for a month, 3 months, a quarter, half a year, you need to be very certain that that play will work out, right? Because if you're holding it for 1 quarter and the next quarter you price reverses and you exit at break even, you've wasted 2 quarters and you've made nothing, right? So in the lower time frames, in these market conditions, I personally feel like even that's why I've had to shift my approach and bring on day traders and say, hey, I might have this approach, I might have this trade setup in mind, but anytime you can jump in and do what you do best, help me do that as well, so we can increase our profitability.
Now that you've had a bit of a taste for more intraday trading through your colleagues, I want to hear your thoughts on preferences. The reason I say this is because my first 4 years in my trading, I was a die-hard swing trader because there is a high risk reward potential there. You can focus on the higher time frames. It just felt more appropriate, especially as traders. I was always taught trade the higher time frames and the trend is your friend. All these buzz sentences, really ingrained beliefs in me. But then when I went down and investigated the lower time frames and intraday opportunities, I actually found, contrarian to popular belief, more certainty, because I didn't see it as noise. I saw it as more information, and more particularly, I remember from maths class maybe binomial tree, where it's like the roots you have as time goes on, where the analogy I actually give is, if you look at gold price and you say, where is it going to be in 5 minutes? And in 5 minutes it could be like a little bit higher, a little bit lower. It's a limited box. If I say, where could gold be in 6 months? It's a bigger box. It could be really high, really high, or maybe even slightly down. Meaning as time goes on, the degree of certainty of outcomes reduces. Despite all the information you have today, new things can develop over time. And then the opportunity cost of the capital being stuck in a specific position, the psychology of having drawdown or heavy retracements, all of these things come with swing. And as you are a swing trader yourself, and now you're exposed to intraday trading, how do you view the two?
So I am personally now, because I've had so many trade reversals on swing, I'm looking in the lower time frame for opportunities.
What is lower time frame for you?
I would say 4 hour, 8 hour for me.
Is lower.
Even down to a 1 hour is lower. But for the day traders within my team, I would say they are 5 minute, 15 minute as low. Never 1 minute, because I don't know how you would interpret that, but 5 minute, 15 minute generally, I would say, has been working for them, right? For me, 1 hour, I would say, is the lowest I would ever go down. So that would be my lower time frame. Now, why I also like that is because you get a lot of very clear moves, very high quality zones on those time frames of 4 hour, 8 hour, 1 hour, that you would have very, very hard time deciphering on the 15 minute, 5 minute, 1 minute, right? On the 5 minute, there's probably 150 supply and demand zones within the same 4 hours, right? So how do you know which one is the right one to take? But if your strategy, if things line up, then by all means, if you feel like you can do it, right? It's just not for me, so I can't really comment too much saying if this works better for someone else or it doesn't. But I know from my experience, those extreme lower time frames, even seconds, it is too difficult. That's when you lose a bit of hair
and a bit of sleep.
But if you time it really well, I mean, I'm sure that people are getting 1 to 20 trades, 1 to 100 even, because if you can time it really phenomenally, then you just let it ride out.
Hey Titans, let's take a quick break to talk about a sponsor of the show. In fact, many people have been talking about it. A lot of noise in the industry about this firm. It is Ola Prime. And before I even consider who to partner up with as a sponsor of the show, I go through a massive due diligence process because I hugely value the platform that we've built and the direction that we're going. Therefore, the most important thing for me is trust and transparency. And a few things that are unique and that I love about Ola Prime is, first of all, they do a 95% profit split. Basically unheard of. So whatever profit you make, you keep 95% of it. And most importantly, 1 hour payouts. Your payouts are practically instantly, practically on demand, so that you can really trade, make profit, withdraw it, and continue to trade. And the best thing that I love is that they've given me a exclusive, massive discount to make them one of the cheapest prop firms to work with on the market. So with prices starting as little as $38, I encourage you to check out everything Ola Prime has to offer. And if you use the link in the description or the code TOT, that'll get you the best prices available with a massive discount. And with that being said, let's get right back into the episode. So I have come across on the show a lot of people that are doing lower time frame, M1 and below even, sometimes even brave enough to do the second time frame. But they are not really going for like, let me look at the 4 hour trend and enter on the seconds time frame and try and catch a huge risk reward. Simply because I think the opportunity cost of holding the trade, if you're 1 to 20 up and you haven't taken a partial, and you're hoping for 1 to 30, it's a negative risk reward of unrealized gain to potential further gain. But I think just catching just hyper scalps, let's call it, or high probability reactions, which is a derivative of what I'm doing. I want to ask, you mentioned, because I'm getting to know your approaches on your firm, you have
your eyes on a lot of things, whereas the commodities market, you're also looking at equities, you're looking at a lot of things. And you also mentioned earlier that you like to have a high level of capital deployment to just have things working. Number one, does this create an environment where it's like we have to be in a trade, and then sometimes you're just forcing, or you're not as conservative as you would be if you would allow the capital to sit? Or is this an optimal approach? And is the reason that you have your eyes across the market is to then suffice this desire to have a lot of involvement in the market? Therefore, you have to look wide to find opportunities across the market.
I think, as well said, I definitely think we do have to look wide. Because there's only a limit, right? If you're a gold expert, you're a commodities expert in just energies, right? Usually those will be moving in one direction. How many trades can you take on the same thing, right? So you do generally want to lower your correlation risk as much as you can. I would say the best fund managers today, the best traders today, or portfolio managers have a very low correlation, right? Now you can have 10 winning positions in FX, right? All doing really well. But as soon as dollar index reverses, goes the other way, how many of your trades are going to start now having the same effect and the same negative effect because they're all linked, right? So correlations, I would say, is a very, very big thing. And that's why looking far and wide, you generally know that one thing having a bad day or having some really bad news come out, or it would even start reversing, is not going to affect other things, is always a great sign.
When you are doing your decision thesis, let's walk through the whole process now. So first is, I've got 20 things on my watch list. Let's break down how you select, and then we'll go from there. So how do you go from, I'm looking at all the markets and I have abundance of opportunity, how do you select which one should have my attention?
So one that came across my table, not because I was looking to invest in it, but as a just an enterprise AI software, right? Who is an AI that is not overvalued or overbought.
Yes.
Obviously, we know NVIDIA, we know Palantir, even Snow, if you've heard of them, are doing really, have all seen the benefits of this AI boom, right? So there is one company that I identified, and I don't know if I want to say, but I will say it. It's called C3. If people want to look it up, they can. And what I'm looking at for this company is, what are the competitors, right? Palantir and so on. How are they doing in terms of their performance? What are their PE ratios, right? What is their technicals, right? So we establish and look at the fundamentals. We also look at what the index is doing because it is on the NASDAQ. How is that working with the NASDAQ? Is NASDAQ a good buying point? If NASDAQ's a good buying point, if this company is also in a good buying point, the competitors, it is kind of lagging to the AI market. We know there is upside. Then I'm looking at kind of moving averages on the 200-day, on the 20-day, and I'm seeing also kind of market sentiment, which is more of a gauge, not really an indicator, I would say. And then from there, I am finding a good price point to enter and kind of letting it ride out. So that is one I'm really excited for. It's called C3.
Okay.
And that is one where I think has so much upside.
Is this outline that you've just mentioned a typical process for every position you would take, where you start off with a fundamental read of the individual company in this case, and then you go towards the market overall, and then an XYZ, or is there multiple approaches?
For equities, I would say this is always my approach.
Okay.
Always to see competitors, always to see the industry, and then kind of zone in onto that company itself. How is it performing within its competitors and in the industry, right? Because they are a business at the end of the day. If they are not progressing, if they're not growing as a business, that reflects in their share value and share price, right?
I'm interested.
So, yeah.
The one thing that stood out to me here is, I can understand everything that you said, understand intrinsic value, understand competitor nature, market share and so forth, market growth overall, hence looking at sentiment of the industry. But what you mentioned, let's say, how it correlates to the index. So this individual firm, if you have a good bias on it, a bullish bias on it, and also the index is coming to a buy zone, why correlate it like that, of like individual company amongst a buying zone within its counterparts? What is the correlation there?
So for this trade specifically, it is a tech stock, right? It is also an AI company, right? The biggest player on the NASDAQ, in the group of NASDAQ, on S&P, on on everything is Nvidia right now, right? It is the golden ticket, right? The hottest one on the block. So to see what the biggest player in the biggest indice is doing is a good indication for us to kind of understand that, hey, if there's upside movement there, most likely it will trickle down into the other tech firms and have that kind of same approach.
Kind of following the sentiments of a rising tide, all ships rise in a rising tide. Something
Well
like
said.
that.
Yeah.
Okay. Once you have identified a bias, once you've identified the fundamentals, the industry and sentiment, everything that you've just discussed, how do you take that idea of, okay, I'm going to be bullish at some point in the near future, I want to look to buy. How do you take that with technicals to not only understand optimal areas but also timing, when to get in?
So for this stock specifically, if you bought the stock today and your stop loss is 0, you can still have a good 1 to 3 return just by now, right? Because the price and how much it can actually move up very, very easily. But when I am looking at the technicals, when it is something that is not bottomed out, I'm always looking to see the monthly, the weekly kind of charts in terms of technicals. And then if I can refine that on a daily, I will. But if I know generally I'm holding it for a while, $2 to $3, maybe even 10% off my price target, I will enter, only because I do not want to miss the boat on these things. However, if I'm very far off my entry target price, I would take half the position, let it come down, and maybe get another entry. Or if it's moved, it's moved. And we can't really control that, right?
So let's say you've looked at the weekly or monthly time frame and you see certain demand areas. I guess it looks like you put a limit to preliminary order, and then if it goes lower into the zone, you can add in again. I'm curious to know, are you doing anything to time it regarding certain rejections on technicals, whether it's a reversal pattern, EMA you mentioned earlier? Is it zone equals entry, or is it zone plus XYZ equals entry?
So zone generally would equal entry, but there are always times where I'm kind of looking at the zone setup itself, right? How good is this zone? Is it a fresh zone, right? How many times has price been in that zone? Does price kind of consolidate within that zone as well? So it is zone plus XYZ. Usually the XYZs come by actually spending time on the analysis, seeing how this stock performs, right? Seeing how the market is moving generally. If I feel like there is a great correction right now and I will miss out, then you have to jump in, right? I will FOMO the trade if I need to FOMO the trade as well, right? Because every other condition is met. If my market timing is not ideal, so be it, right? Sometimes your market timing, everything can be ideal and you still won't get filled, right? Sometimes you'll get filled early, you'll have to wait around for a little bit, right? I would rather, when I feel like I have a sure winner, I want to be in as fast as I can be, right?
Which one do you think is worse? Entering too early and then kind of being stuck in a trade and seeing it through, therefore opportunity cost of the money not being used elsewhere, or entering a bit too late?
I would say entering late. I would always say entering late. For me, sometimes you get really good entries late, but if you entered late and at a different price point that might not be within the same zone, then you've done your analysis incorrectly, right? So for me, I wouldn't say entry too late. I would say enter early, let it ride out. Fundamentals take time to change, right? Yes. Also, when larger institutional traders are deploying their funds, they usually are typically not buying huge positions all at one price point, just hitting market order filled, right? Even large institutions, when they are purchasing large volumes of stocks, they have their own algorithm to enter the market without so much price manipulation, right? So that could be also why I generally would prefer to be in. And if it's a losing trade, it's a losing trade. You find another entry, you go again if you still feel that high of a conviction.
With that being said, it makes sense why you would at times just zone is enough and then let the market do the heavy lifting. I'm curious to know when it comes to execution time, because you mentioned certain things that would make you enter the market, and it sounded like it was sentiment and fundamentally related. Is there any technicals you would use to say, okay, I'm in the zone, I'm going to wait for XYZ in technicals to appear, whether it's strictly just price action, market structure, I don't know, or it could even be in certain things like options, order flow. Is there other things you're looking at, or it's more this slow sentiment shift?
That is the fundamental conditions. The technical conditions, I would say, is an oscillator. Use a couple of them. I would say open interest is very good for me to see. OBV is very good for me to see. Moving averages on the 200-day, 20-day is something that I also like to see. I do use also Larry Williams. It's called the Williams R percentage. So sometimes I do add that as well, only because sometimes I've seen it work, sometimes it doesn't work.
What is this one? I'm not familiar.
This is one of his own like suite of indicators that he put out. This was one of them that I was using from the past. Today, I don't really see the relevance, but sometimes I just add it and say, hey, let's have a look. But generally, volume, price, open interest for me is the big one. Moving averages is also a big one for me. And then mostly focusing on zones in terms of its technical setup. All the other indicators for me can be mostly noise, right? Only because on the lower time frames, these indicators can switch and change a lot. But on the higher time frames, they usually take time to move. So I'm always looking bigger picture and then trying to establish if this zone is good. If yes, take it. Go ahead.
With regards to the exit, would you follow a similar process where you're looking at sentiment change to your bias, you're looking at these indicators to change to your bias, and then eventually multiple exits to slowly take your position off? Or is it predetermined levels upon your entry?
It varies, but typically when my trade is close to exiting, I will watch. I will not move. I will be sat in front of a screen, and I could be sat there from market close all the way up until Asia pre-market open, right? So I will not sleep the entire night. I will see how market opens, right? Because at that point of time, if any orders are placed in the market for market open that might go against it, I don't want to wait another week just to find the right exit, right? If that exit is maybe will give me a small percentage extra, cut it right there and then, right? And then deal with the consequences, or just be grateful for your win and take it home, right? You can never squeeze out every last dollar of every last trade, so just book it and move on. But usually exiting, I'm walking around the whole place. I'm looking 10 times over. Market opens, I'm stuck there looking at the screen. But that's only for exits.
Is the reason that because let's say best case scenario is your price comes to, shows a bit of consolidation and then stays at your key level, and then you see reasons to exit. That's best case scenario. Worst case scenario is price starts to give this retracement that you're not desiring. Market opens and you're seeing bearish price action in a buy. You're like, okay, let me get out now because I'm not seeing the right things. But obviously you have a little bit of a price came a bit lower. You didn't book as much as if you just left it on the key level. Is the reason you do this simply for the fact that you might just hold the trade longer if you don't see the wrong thing?
I would hold the trade longer.
So therefore your predetermined profit levels, they're not levels of like, let's get out. It's levels to monitor because there could be a reversal. If there's no reversal, let's keep holding it.
There are levels of, I would say, different price points where we know that most people would also take shorts. And usually these are kind of like round figures. If price might break over this, like $100 price target, right? If a stock has never past $100, once it touches that, it might just have a huge reversal, right? But if your price target is $99, you'll be out very easily. But if it's 105, for example, then you'd have to play that game for a little bit longer. So for me, I always like to monitor exits on longer time frame trades, only because if I can squeeze out that last extra percent, that is me doing my job the best that I can, right? But if I see a reversal, then as soon as I book the profits, I do not think twice about that trade. I don't even think about, I should have waited, what's going to happen tomorrow. No, I'm done, right? Once it's booked, it's done. I'm happy about it. I move on.
How do you navigate the debate of break even early to protect yourself, capital exposure limitation, versus giving a trade room to play out and accepting the risk that you initially had? Which side do you sit on?
For me, I sit on the side of follow your process, right? Set your trade. If you know the analysis is correct, great. If you've entered, if you haven't entered and you have room to make and time to make adjustments, adjust it as you see. But once you've entered, don't kind of have very fixed rules that I have to wait for 1 to 1, 1 to 2, 1 to this much. I have to make X amount of money on this to exit. Just follow price action, I would say. But when it comes to actually entry and waiting for my price target to be met or for the direction to be followed that I'm anticipating, I will wait with my stop loss being as is, right? If it does kind of consolidate, leaves its zone, maybe I'm in 0.5 R, 1 R, I am not moving my stop loss to break even just yet, right? I want to see growth. If I'm waiting there and I'm already entered into the market, I've accepted the consequences of that trade being a losing trade, right? So for me to exit or for me to move my stop loss to break even very early on, for me doesn't, from my own back testing, doesn't give me the room that I need. For someone else, it could be different.
And you mentioned following price, and as price moves away from your entry and you're in a decent amount of profit, will you trail your stop, or is upon your break-even protocol you will leave it at break-even and then you wait for the market to reach levels and no trail?
So sometimes I trail. I would say maybe 25% of the times I trail, but I would say 75% of times I would actually move my stop loss to break even and not actually have a realistic take profit price in mind, right? I would keep my take profit just there, but it would be so far out of the price that it's not going to get hit. And I keep it there just because if I identify where I think price will likely rebound off, then I'll just move that that take profit to that price point. However, like I said, my exits are mostly very, very much manual and based on price action, which is why there is a need to also have a very good technical understanding of the market to see and identify whatever you need to in order to make your best decision. Yeah.
Do you partial out when you're at certain levels and you're seeing rejection, or it's a full position exit?
I usually I don't usually take partials unless I have reached where I want to be very early on, and I'm like, why is that, right? What is the market telling me, and is there room to capitalize more? And if there is, then I would say, hey, let's leave some runners on this position. Let's size off a little bit, and then go from there. Yeah.
Do you have a separate portfolio or part of your funds where it's certain things that you just know are going to be bullish, let's say AI related things, but they might have temporary pain, but in a 2-year, 3-year time horizon, they'll most likely be up. And then another part for just day trading or even swing trading, but for this year. Do you divide it like this, or is it only, let's say, profits that you can make this year, not necessarily multi-year investing?
No, because we do both. You have to look at those timeframes, because even certain clients, they don't want their funds traded. They want their funds invested, and they are happy to even do that in an ETF that you recommend, right? Or just tell them where to invest their funds, right? Even just as an advisor. So some people want that approach. For me, if I see different opportunities on different timeframes, I want to take all of them. Why? Because if I've done my analysis and I've done my research correctly, they should work out, right? Simply put. So I will jump in whenever I feel like I want to jump in. But that's also based on the process and everything that needs to be met before that.
Yeah, the reason I asked is because there are certain trades where you're taking full volume out, you're exiting your position, but there's a lot of long-term upside, but that's kind of counteracted by your long-term holdings. I want to now touch upon risk. And on the show, we've had a lot of various ideas and debates and discussions on the idea on how to approach risk, where there is counter trend trading, and it can be trade type risk, it can also be position sizing risk, it can be high conviction equals what's the word, if you have a high conviction you might as well load up on risk. It can be laddering in entries, there's a lot pyramiding, there's a lot of approaches to risk. How do you do it, and is it a static approach where it's like one policy for all funds, or is it client to client based?
I generally love a ladder-based approach for entries, for even sometimes exits. When I know that, hey, I'm not going to be able to stay awake any longer on watching this trade play out, I want to exit this trade, I will leave a ladder-based approach in terms of both sides, right? When it comes to entries, why I prefer that in entries is because if price retraces and I have 0.25%, maybe let's say 4 times to make that 1%, and I get really solid entries there, I know I have a lot more flexibility once price starts retracing back to where I need it to be, if it's counter trend, for example, right? Or if it's trend following and I've got my entry price and now we start to see some movement, then what I can do is also start moving my stop losses. Earlier positions can be exited much earlier because they haven't got the most favorable price point, right? So that's why I do generally appreciate kind of taking it on a ladder system. Pyramid system I've never done. I don't think something that I would do. But in terms of risk management specifically, everyone within my team has their own rules. I don't interfere with them. Me personally, I always like to keep maybe, I would say 0.5 to 2% in terms of the max I would risk per month, right?
Okay.
Only because if a client says, hey, I want 5% to 6% a month, I'm doubling up my risk that I would usually take per month. Only because I'm much more conservative than I would say most people like to be. But that doesn't mean that once I have buffered profit that I wouldn't take lower risk setups. I do tend to allow myself to take riskier trades, take trades that I might not have the highest conviction, but I do want, or I do see certain things that would qualify it as a good trade. Then I would say, hey, because we're in profit right now, let's put that to work. Because it's kind of like a free bet running.
Yeah, it's interesting where you risk is not only based on the trade, but it's also based on how we're performing lately. If we have a profit buffer that we can use, then we can be a little bit more aggressive. I think that makes a lot of sense. I want to bring the conversation more towards the retail realm because although you are trading in the same markets as we are, you're trading in a different capacity. So I want to hear, first of all, before we get into prop firms, the industry, and all the things you may be exposed to, now that you've had a taste of both sides, I want to hear your thoughts in the sense of, as a young trader and a lot of new traders, I had this belief of the goal one day is to manage other people's money and become a professional trader, and there is a lot of allure to it. There is obviously the movie side where we see that's the cool life, the high rolling life, but also it just feels professional, it feels like a career, and it's something that I know my parents would love, let's say, because then it looks like I have a job and something serious is going on. But at the same time, you do lose freedom because now you have a fiduciary responsibility, a client responsibility. You have a lot more pressure. You probably can't just say, I want to take a 2-week break, because there's that responsibility there. So therefore, you do lose an element of freedom, which is what a lot of traders crave. So I want to hear your thoughts. Is this a worthwhile journey to go from an individual trader to trading other people's money? And looking back, would you do it again?
I would definitely do it again looking back. If you can manage the pressure, then I think it is for you, right? Ultimately, for most people watching, if they do have the opportunity with obviously a track record, and they can go into it and they feel like they want to, you would only know if you can do something by actually doing it, right? By sitting on the side and thinking, if I can, it's never going to work out in the way you want it to be, right? Even when you do start it, you will have some obstacles that you have to face. You might be or just on the cusp of taking on investor funds, but then have your worst month ever, right? It is all about how you manage your kind of business, or even your own trading journey, which is like a business, right? Whatever you invest, you should be getting out. You deal with the issues that come almost daily, market conditions, clients being upset if they are upset, and so on and so forth, right? But generally, I've been having a great time doing it. Okay. I've really enjoyed the people that I get to work with. And I've had a great time. I cannot really say anything bad about it. Yes, you do also have some clients that are a bit of a headache, but for me, I don't see that as the biggest deal. Yeah, I don't think that's really something that would stop someone.
How much of your time is now devoted to everything around the business, which it is in the end, where you have client relationships, you have marketing, you have sales, to convert interest to a deposit. There's a lot of these external responsibilities you have beyond just keeping your eyes on the markets and appropriate trading, risk management, size, all of these things that we've just spent the conversation on. That's a full-time job. But then you've also got the whole enterprise as well of making sure everything is running smoothly, you're growing as a firm and so forth. How do you manage everything?
It is very difficult to have the consistency in your own work ethic play out month after month when you are putting in those 16, 18-hour days regularly, when you're working weekends regularly, because market's closed, but that means you have to focus on the marketing, the sales side. And this is the only time you have to do that. You have to be on go 24/7, right? Where your positions are. If you are out on the beach traveling, having a good time, you don't look at your positions and something major is happening, no one is going to call you and tell you, hey, take your positions off. The broker is certainly not going to tell you, hey, maybe it's best for you to book your profits now, right? So you have to be on top of your own game. Anyone who wants to start small and continue to grow and expand, and make sure those lessons you learn are not very expensive lessons, right? So that in the future you aren't facing those issues. But generally for me, it has been very difficult. It's been a constant kind of grind, but that is something that drives me, right? For me, my target by the end of this decade is to have over 100 million in assets under management. So for me, my journey is going to be upwards and onwards, whether I like it or not. I just get to have the benefit of having the time freedom, the money freedom when I decide to use it, right? But that doesn't mean I have it all the time. It's because I'm working towards something that I want to personally achieve. And in my pursuit of that, the sacrifices, the time that gets spent doing that, the expensive mistakes also are just part of the journey. So for everyone who wants to do it, do it.
I've spoken to a variety of guests on the show, and a unanimous common denominator between all of them is the emphasis they put on data and actually knowing the inner workings and the insights of your edge and your performance. That's why I'm proud to bring a partner of the show, TradeZeller, the number one journaling, backtesting, and all-in-one insights experience created by traders for traders. What TradeZeller really gives you is deep insights about your trading that would ordinarily not be visible, whether it's through understanding your trade types and playbooks, or even insights powered by artificial intelligence through Zeller AI. Whether you trade Forex, futures, cryptos, the stock market, it all seamlessly connects to TradeZeller, so there is no additional work. You've seen me reference it dozens of times and all of the benefits I've had in my trading from the insights I found from my TradeZeller. So join myself and thousands of other viewers of the show. You'll get the best discount using the link in the description or code TOT for Titans of Tomorrow. I want to explore this idea. So a big reason I think recently people are deterred from this potential route is not only because it's extremely hard, there's legal, there's compliance, there's regulations, there's a lot of things, qualifications that you may need, I don't know. But there's also prop firms. And the reason I bring this up as a direct comparison is because in your sense, you have clients that you have to follow their rules. In prop firms, you have also certain rules. Now, prop firm rules, people see them as they're restricting me and so forth. But a client saying to you, hey, I don't want to trade these assets, I don't want to have this kind of risk exposure, is also a limitation on your free will of how you would normally operate, and it would also restrict your profits. So there is pros and cons in both. But what I want to ask here is, if I had, with prop firms, it's pretty easy to get 100,000, 200,000, arguably even 500,000 pretty easily under management, but it would have the buying power, or it would have the potential as an individual to have the yield of someone with millions in assets under management, because you have like a 90-10% profit split in my favor, whereas in a client relationship it would only be the minority is in my favor. So you'd have to have so much more capital with real clients to deal with, to just offset 500k in profit money where 90% of the profit is yours. At what point do you see the trade-off is like, okay, you would outgrow prop firms at this level in terms of just personal growth, personal finances, or do you think prop firms is just a hack, it's lucrative, why not take it while it's here?
I would 100% recommend prop firms if you have access to them in your country. If you feel like you can make that 15, whatever the profit target is, consistently, go down the route of prop firms to not only just to trade, but to validate your own strategy as well, to get a good feel of the markets without having the huge downside, right? Because your most expensive challenge today is going to cost you less than $10,000, right? Much less. So for you to take a challenge account, great. You can go down the route. You can go down the route of instant funds also as a prop firm. You have many routes. But why I would say certain traders coming from institution prefer real larger funds in a brokerage is because you have flexibility. I cannot take an options trade on a prop firm currently today, right? But I can do that on interactive brokers while also taking a swing trade, while also having a day trade running all at the same time, right? So that's where you have more flexibility. The profit commission of prop firms is actually a hack if you know what you're doing. I would say most people should start there. But the flexibility of products is only available on brokers, which is usually the US brokers that will have a lot more data, a lot more options, a lot more different things that you could invest in, especially in the futures market. Today, I think the prop firms that have the most amount of assets are the ones that will generally do a lot better because they can attract more niche players. But they do not have, for example, a product specialist like a broker would that you can speak to and say, hey, I want to trade this asset. Please add it to my brokerage account and please update the feeds, right? So that's the only trade-off, but I don't see that as a trade-off.
Right.
Yeah.
In your goal towards $100 million assets under management, from the amount you have now to where you want to be, what do you have to learn or what do you have to do different to grow into that level?
I just need time. I feel like being young doesn't work well with the investment landscape. Yeah, the trust factor isn't there. You could be a young prodigy, but at the end of the day, you're a young prodigy, right? For me, there are fund managers who have the track record that's older than I am, maybe twice as old as I am, right? So how do you convey that you can stand the test of time, which is in these markets quite difficult, is just a matter of me building my track record. So I know what I'm capable of achieving. I know how long it will take me to achieve it. But I also know the more I have, which is time spent in the markets under my belt, will be better for clients to see. So it's just a matter of time for me. Obstacles are going to be there no matter what. So it's just a long game that I'm playing now. Yeah.
And the last thing I want to end the conversation on is you're taking a route as a young person, and there's probably just like prop firms is a wild west, so is the wealth management space. Who's guiding you, or did you have any early mentors, or do you have any current mentors that allowed you to be the position you're in?
So I've had, honestly, the pleasure of having really, really good mentors from my institutional days, even mentors who aren't traders in my personal life. So I've had a hedge fund owner who's still my mentor today, right? His approach is not the same as my approach. He's not discretionary at all, right? However, the way he looks at the market as a macroeconomist, the things that he's taught me, the things he tells me regularly as well, is something that kind of makes me take a step back, right? Even you can have one of your best months and you want to say, hey, I want to now spend all that money, flex and do this. But when I'm seeing someone who's achieved the same thing, 1000x that I have, and he's not acting in the same manner that I'm thinking I should be acting or taking the same approach, I have to kind of take a step back and say, why do I want to do this? Is this going to take me to where this person has gone, right? So it's a bit of that, I would say.
Very interesting.
Yeah.
Last thing I want to end off on is you've mentioned a discretionary approach, and a peer of yours is completely mechanical or a different approach. I had a conversation with Jared Tendler, who's an author of a book called The Mental Game of Trading, and he elaborated on intuition, which is what a lot of people exercise their subjectivity on, their intuition, to have a discretionary approach. And he described intuition as, I thought intuition is mastery. It's an element of you're so good at something that it's just ingrained as a gut feeling, or it's ingrained as subconscious wiring. He argued that actually intuition is something you haven't fully understood yet. It's pattern recognition that you're starting to get, but you haven't verbalized or you haven't understood enough to make it a rule, or to speak it out loud, or to make it mechanical. And therefore intuition is not to be trusted in that way. How do you deploy discretion? Because there are certain things you've mentioned today of something that is not a great setup, but it's still worthwhile taking. A bit of discretion there, a bit of discretion on your risk appetite, discretion on how you analyze the market. There is subjective approaches that you're doing. What is the base of that to say, this is the reason I can deploy mental aptitude, not just rules?
I generally agree with that gentleman when he spoke about intuition. For me, a lot of what I do is based on intuition, right? Once my process is met, once my criteria are met, then it's just up to what you feel, right? What do you want to do in that moment? So I trust myself a lot when I am executing. Doesn't mean that I'm 100% accurate, right? It just means that ultimately you have to trust yourself, and you have to trust your own process that you have built out, right? There's a lot of educators in the space that can teach you a lot of great stuff about their strategy, right? And you want to use those educators to understand their strategy and add those as confluences to your own strategy. So even I, till today, look at different trading educators to see what is this person doing, what is this person doing, right? But then ultimately I feed that back into what should I be doing, right? Is this useful for me? Is this information good for me? So a lot of times what you see is, yes, you have to use your own intuition, because once every criteria is met and you enter the trade, you still might have a losing trade, right? But your intuition will be the driving factor that will give you that extra, I would say 20% mentally for you to think, hey, let this trade ride out. Or if it could be a losing trade and you want to cut it early, that intuition might also jump in and say, hey, this is the price action has now flipped, right? So maybe I should cut this early. Yeah.
Man, a lot of unique perspectives and a fresh insight for the show with the wealth manager over here. So, my man, thank you very much for joining us today. It was a wonderful episode.
My pleasure, and lovely to see you as well.
Epic stuff, bro. Great work, great work.
My pleasure.